Hey everyone, this is Finding Value, and I just wanted to share something with you. Whenever you have these really long, drawn out, big chart patterns, it means that gigantic moves are coming. And I was researching through a couple of things to present to you guys. One of those things was the underperformance of mining companies in relationship to gold. And we've seen over time, and this isn't 100% of the time, because it really matters where you are in your cycle for mining companies. And in the last boom of precious metals, and the boom was the 2000 to 2011 top. We're looking at a mining chart, and right here you can see we had it kind of pulling up pretty good in that early boom phase, and then it fizzled out. It fizzled out and it broke the relationship. The mining companies broke their relationship and their advantage to the price of gold, because gold went up all the way till 2011. And if you notice, the mining companies didn't follow. And I buy a lot of physical metals because the physical metals have zero risk in relationship to what the mining companies have. Precious metals is you're just 100% based off of the price. It doesn't matter input costs. It doesn't matter if a country takes over those assets from a private company, they nationalize it. It doesn't matter what management does. It doesn't matter about share dilutions. None of that matters if you own the metal. It's very low risk, direct to your pocket. And if you ever get a massive shortage in the future, you have the physical metal that everybody wants. So it is a very low risk way. So you want to hold the majority of if you're going to play the precious metals game, I prefer to do it through a physical precious metal. Now, I do own mining companies, and it is a substantial amount. I wanted to share this breakout here. So we understand that there's not a direct correlation sometimes, that the mining companies may vastly underperform the physical precious metal as it did from 2004 to 2011. But if we have a major super cycle that's coming, which I think we do, I wanted to share this chart with you. This chart is a gigantic declining kind of wedge pattern. And the longer this pattern is, the more upside it's going to have. So what we're looking at is a gold mining index in relationship to the price of gold. So if you notice, this had an underperformance from 2004 all the way down to 2019. That means that the gold mining index was underperforming gold itself. So what we're looking at here is a gigantic pattern. This is many years, all the way to 2004 to basically 2019. That's a 15-year plus pattern here. And we broke out the upside in 2019. We made a move higher, but what this means is that we are going to make, if this pattern is reliable and works, which I think it is, we could have massive upside in the mining companies. Massive. And by looking at this, and let's just say we're at 0.15, it's 0.1663, but let's just take it from 0.15 all the way up to 0.625, which is what that valuation is in that 04 time frame. So the way that you would calculate this is you type in 0.625 divided by 0.15. The upside is 4.16 times the price of gold. So if gold goes up 4 times, we multiply it by 4.16, and that is what the HUI, HUI, is going to return. 16.64. Now, some of these junior companies, they're going to go ballistic. That's where I put my money is a lot. So another thing to think about is we know that it broke out to the upside. We've got a lot of upside potential. So we have to think, how do we want to play this? Well, how do we, make a portfolio of these mining companies? My suggestion would be to go out and look at some of these juniors and sprinkle money about them of what you think the best junior mining companies are. Get them into the individual companies because they're going to go absolutely berserk on the upside. And all you have to do is catch a few of them. You don't have to catch every single one. You could have 200 or 300 performers, but if you catch 2 or 3 and they go up 100-fold, that's all it takes. $2,000 at 100-fold, big money. I also think you need to have some money in some of these the indices like GDX, GDXJ. Those are 2 very good ETFs. The way you can play GDX is the major companies, GDXJ is the junior companies. So I think it's good to get some money into GDX and GDXJ so you catch the move of the entire group. And then if you can't go into ETFs and you have mutual funds, you can pick like Fidelity Select Gold or like a Wells Fargo Gold Fund or something like that in a mutual fund if you're restricted in your account to only mutual funds like a 401k is. Nonetheless, we have a gigantic pattern. It's broke to the upside, and we're going to have a massive outperformance of the miners in relationship to gold itself. This is the time to structure your portfolio. Get in these mining companies before they really take off. And they're going to take off. It's going to be very quick, and it's going to feel like you're going to chase them. So I think you need to get in now. I think you need to put down a portfolio, think about it, get your mining companies. I am sharing my picks in the junior sector if you'd like to watch them, if you'd like to do some further research on them, and if you want to partake in some of those, that's fine. But get ready for this because it's going to be spectacular. This is Finding Value. Leave comments below, click subscribe, and thank you for listening.